The biggest story in the global capital markets today was oil, which gapped open much higher after the bombing in Saudi Arabia that took nearly half of the output offline for at least a couple of days. In turn, in the currency market, the biggest beneficiary was the Canadian dollar, which gapped lower and essentially stayed very strong through most of Asian session trade, but then began to lose some of its momentum as basically oil started to fall, and the market began to feel that this was a one-off event. Basically because President Trump and Russian oil minister Novak assured the market that there was plenty of reserves of oil to replace the current production decline, Canadian dollar started to lose some of its luster simply because at this point the market is really much more worried about the Canadian election than the strength of the Canadian oil as a replacement substitute. However, over a long run, if the Middle East tensions continue to persist, and if this is not the only drone attack on the Saudi Arabian assets, the Canadian oil is going to become much more lucrative and much more attractive as a safe harbor asset, and that in turn should provide a much more durable long-term bid for the Canadian dollar. For now, the Canadian dollar remains relatively steady at around the 132 spot rate or around the 78-79 cent level. But should the oil prices begin to percolate higher, and more importantly, should there become more consistent Middle East tensions as we go forward, it's very likely that it's going to create a long-term bullish bid in the Canadian dollar, and you could see the Canadian dollar slip to below 77 cents in a futures basis. That's the biggest story in the currency market today. This is Boris Schlossberg from NYMEX.